What is going on, investors? Hopefully you guys are doing well out there. Time to give you an update on Teladoc Health, ticker symbol TDOC. Over the last year, stock's down ginormously, down 71%. I don't even know if that's a word, but it's hard to believe that even year to date, you're down 54% on this. When we slide over here to the valuation, it says right here a $6.4 billion valuation, but that is not factoring in the 24% decline or $10 per share drop that we're seeing in the after hours on this one. We'll see if it follows through into tomorrow. It's Thursday tomorrow. I'm recording this the night that Teladoc reported their earnings. We'll see if it slides down to about $30 per share heading in tomorrow. If it does, that would take you south of a $5 billion valuation over at Teladoc Health. This on a company that is producing nearly $600 million worth of revenue in a quarter, good for about 17.7% growth year over year. They even beat those expectations a little bit. So you got about a $2.5 billion run rate if you look forward with Teladoc. If you look at the analyst estimates on this one and you factor in that these analyst estimates are probably going to have to be walked back just a little bit because Teladoc Health did give Q3 guidance, which came in between $600 and $620 million. Consensus was closer to $618 million, which would have represented about 18% growth. I see for the foreseeable future, analysts had this at about an 18 to 20% grower. My guess is in the coming weeks, Teladoc analysts will probably pull this back to like a 10 to 15% grower for the foreseeable future. That will likely be consensus over here. And look, you still have a company producing $2.5 billion worth of revenue for a full year. So you're trading at just 2 times sales on this one. Now, the unfortunate thing is it appears that our earnings or our profits are simply not going to be existing over at Teladoc for the foreseeable future as well. That is going to scare a lot of investors away, including the stock chart, which we'll talk about here in a second, has pulled into a range that's a little bit interesting. If you follow the channel, you know I've been very critical on the stock. We were never really on the Teladoc train, and there's some reasons why. And I'll show you here from $503 million last year, up about 17% to this $592. One of the reasons why we're still following this company is, I tell you what, if they can clean up their act on these costs, and look, they have some one-time charges in the most recent quarter and over the last 6 months that have devastated the financials. I tell you what, we'll put those to the side and we'll still see a company struggling to scale up its business. But look, they have incredible gross margins at $182 million in cost to generate this $592. That's fantastic. That's tech-like. In fact, that's better than a lot of tech that we're looking at. Now, unfortunately, we spent a lot on advertising and marketing. Look, over the last year, we spent $103 last year, and that went up by about $60 million to $164 million. The reason why that's a problem is you went up $60 million on your marketing spend, and unfortunately, your revenue just climbed $92 million. Now, I understand the sales cycle probably is pretty long, and the total value or the long-term value of a customer over at Teladoc probably rather large. So you spend a fair amount on marketing to capture customers and capture their revenue over a long period of time, but it looks ugly in the most recent quarter. Now, sales, those expenses actually went down. When you look at technology and development, sideways quarter for that. General administrative, I'm encouraged. The fact we're finally seeing sideways quarters there. Acquisition, integration, and transformation costs. Now, these went down by about $9 million year over year, but unfortunately, we had to take a massive goodwill impairment over at Teladoc to the tune of $3 billion in the most recent quarter. Over the last 6 months, it's $9.6 billion. When a company like Teladoc makes an acquisition like they did at the height of the valuation of not only this company, but Livongo Health as well, and the total value of the company shrivels to a $5 billion valuation, and they did a $9 billion write-off over the last 6 months. That is devastating for the company, and it's devastating for shareholders, and we see the result of this. Quite frankly, you can learn something, though, from Teladoc. This applies to a lot of stocks that I've looked at over the years, including another pretty big company, including Under Armour, which made some bad acquisitions, had to make goodwill impairments, had to do a lot of restructuring, and even lost their founder and CEO. Those things can devastate a company for actually a pretty long period of time. But let's strip that out, okay? Let's ignore that fact, okay? Companies do do that. Okay, those things happen. And if you're not invested in Teladoc, I tell you what, these things happening, bringing the company down to a 2x sales mark could actually be a good thing. Let's strip out the $3 billion. You've got $688 million worth of total expenses. That's still up over $100 million from the previous year. So we're growing our revenues by about $90 million, but our total expenses climbed by $100 million. Again, that's not factoring in the $3 billion non-cash goodwill impairment. For the last 6 months, paints a similar story. Let's go ahead and strip out the $9.6 billion, and you're still seeing expenses climb on about a $100 million run rate per quarter. That is a problem, although it's getting slightly better. It's masked a little bit by the fact that a lot of investors are still digesting the fact that this company had over $9.6 billion worth of write-downs just on a company they bought just recently. Now you come over to cash flows over at Teladoc, paints a slightly different story. It's so glorious when that goodwill impairment charge is a non-cash charge. You get to add that back in on cash flows. We also see that stock-based compensation over the last year, I tell you what, when on a GAAP basis, you go from $330 million net loss to $9.7 billion. The executives probably should take a pay cut over at Teladoc. You went down from 170 down to 111 on that stock-based compensation side. Looking forward, if they can start to flatten this out, and we certainly saw evidence of it when we looked at these expenses, while they did rise still rather significantly, most of that had to do with advertising and marketing. And if you believe in the long-term story and the long-term value of customer at this company, well, spending that on advertising and marketing, not always the worst thing. So if the stock-based compensation can flatten out a little bit, the financials on this company could start to turn around, not necessarily next year, but maybe if you start looking 2-3 years down the road. The net cash provided by the operating activities actually looks okay. And from this perspective, this is probably how you want to analyze this company to a certain degree. Went up from 34 million up to 60 million because it's scary from a net loss perspective when you look at $9.7 billion, but understand $9.6 billion of that was non-cash, and another $110 million was stock-based compensation, also not cash. Unfortunately, though, stock-based compensation very dilutive, especially when the stock continues to go down. The total number of shares that they issue for this 111 actually is probably greater than the 169 they did last year, just due to the fact that the stock continues to go down in value. So the more and more money means more and more shares. They realized some hefty capitalized software expenses in the most recent quarter as well at $69 million. Last year on a 6-month basis, it was closer to 21. I'm imagining that these costs are somewhat lumpy and this won't be kind of an annualized thing. And so that's something that could clear away 6 months, 12 months down the road as well. But when you factor in everything over this company, including the positive cash flows of $60.7 million, they still burned through over the last 6 months. They burned through about $10.2 million in cash. The reason why that is somewhat important is we don't have a massive cash pile over at Teladoc Health. Yes, we do have $881 million, but this company could go through a prolonged period of time where they don't make money, and maybe they want to continue to spend on advertising and spend on other things. On top of that, you have this stock absolutely falling off a cliff, so it's difficult to compensate your employees with a stock nobody really wants. And so they might be having to come out of their pocket a little bit more into the future when it comes to cash. Now, the good news is, kind of good news, bad news is, they don't really have a ton of liabilities over on this balance sheet. You do have these convertible notes, which is another form of dilution, but other than that, there's not a ton here to be really concerned about. So the reason why it can be good news, bad news for investors is, yeah, they might blow up the liability side of this balance sheet, take on some bank debt, issue some more convertible notes, issue some more shares of this company after it's already been under the pressure it's on now. Clearly the trend over at Teladoc Health, I don't need to tell anybody, especially anybody that's been long this name for any length of time, the massive trend is down. And so I want to remind you of that fact. In fact, this goes for the vast majority of the stock market. The intermediate or year-to-date trend is down with a lot of stocks. So even though we're seeing some pretty healthy rallies, and quite frankly, Teladoc Health over the last couple of months has gone from like a $28 stock, and earlier today, it was all the way up here at about $43 per share. So in the shorter term, that's why we're still looking at some of these stocks. Some of you that are kind of shorter term want to make some quicker money. There's certainly opportunities in this market. Now, I put in a fake red candle here because the after hours is not showing. I think I need to reset my settings on my chart, but we'll put in a fake candle. And this stock, quite frankly, though, from a technical perspective, still doesn't look terrible. And again, I'm talking about in the short term. When you zoom this out, obviously it's a complete disaster. But in the shorter term, we're actually making a predictable trading pattern if you do want to make money. Now, if you're one of these poor souls that have been in this a while, look, I'm not going to advise you on what you should do. Next time you buy a speculative stock like this, put some stop losses, okay? I do this on stocks, and people are sometimes shocked to find out that it's like the Nvidias and the Teslas of the world, but those stocks are somewhat speculative when you look at their valuation and you look at the volatility in those names. I set stop losses in those names because they can swing 20 to 30%, and you don't really want to lose that type of money in your portfolio. So next time you buy a speculative stock like Teladoc, make sure you have a stop loss. Make sure you have a point where you get out of these names, because then it allows you to potentially get back in. Now, if you've been holding this stock and you want a dollar cost average into it for some reason, well, we're likely to put up a big red candle to the bottom of the range. If you believe this technical pattern is going to hold, this stock should find some footing down here at about $30 per share, and then we should follow that up at some point with some green candles. Again, this is if this technical pattern is in place. Let's assume the bad stuff happens and this technical pattern is not in place. I would want a stop loss at the very lowest, the previous lows that we made down here on the stock, essentially the 52-week low on this stock, down here at about $27 per share. You do not, and I repeat, you do not want to hold Teladoc stock on a break down through 27. If you go down through 27 on this one, really, really bad things are going to happen, like probably retesting under $10 per share. From a technical perspective, that is highly probable if you make a new 52-week low on this stock. Now, that's your plan to get out of this one. If you were going to buy the dip down to the bottom, again, of this small technical pattern. Again, the first part of these videos and virtually every video that I post talks about the fundamentals. We're talking about a year, 2 years down the line. We're talking about valuations. We're talking about analyst estimates into the future. We're speaking more to kind of the buy and hold investor. The technical pattern is for somebody, even the buy and hold investor that wants to make smart buys. They certainly can combine a little bit of technical analysis with that, but you can also play this from the shorter term. And the shorter term, if this pattern holds up, we should retest down here at about $30 per share, should rally. Make sure you get out of these ones. Every trade should have a stop loss and an exit point. I would probably put the whole thing on when you put that trade in. So you buy at 30, you put a stop loss at 28, and you put a trailing stop at some percentage basis on the way up. If you're manually doing this, there's areas of resistance here at about 35. I would play this one from 30 to 35, get out of some shares here, lock in some profits, and then trailing stop this one to the top of the range. That's what we're seeing from a shorter term perspective. This doesn't just apply to Teladoc. We're seeing a lot of very speculative stocks that, yes, had an incredible run, burned a ton of investors up here at the top, a lot of bag holders on this one, but a lot of people call these cigar butt businesses where there's still one last good puff to make some money on these, and certainly the shorter term volatility can be there. I would recommend that, quite frankly, only for the experienced trader that can set stop losses and get out of these stocks. For the longer term, we have to imagine there's some kind of put option under a stock trading at 2 times sales, which is actually the combination of both Teladoc Health and Livongo, both at one point worth tens of billions of dollars. now combined worth less than 5. You have to imagine somebody out there would want to acquire this company and probably could see some synergies, how they could reduce costs and cut the debt weight at the executive level, which clearly have been doing an absolutely terrible job. Where that level is in these types of markets is still probably considerably lower. And quite frankly, we haven't heard a lot of rumors about Teladoc Health being acquired, so there appears to not be a suitor in the shorter term. I wouldn't count on that for a bailout, but it is a possibility when you have stocks down this big. Hopefully you guys enjoyed today's video. Back again soon with more. Good luck with your investments.